Recording in progress.
Hey Ryan, how you doing? I can see your picture. Do we have good audio visual?
Yep. Doing all right yourself?
Okay, right on. I'm doing okay. Doing okay. It's Monday.
Yeah, I hear you.
Hey, what's happening, my friend? Hanging in there? How about yourself? Connor, are you going to Indy?
I am not. Are you staying in that house with everybody?
No, I got a hotel room down by the Star. But it looks like there's gonna be a good crew up there. It'd be fun to see everybody run.
Yeah, it should be a good one.
Okay, it's 7 o'clock, so I'm gonna get started. We're a little bit light tonight. I don't know where everybody is. Maybe they looked ahead on the syllabus and saw we were talking about intra-corporate investments tonight and decided to catch that at a later date. Frankly, I wouldn't blame you. This is one of the most technically challenging modules in the whole book. Module 9 and Module 10 are, I'll just say they're the deepest accounting, and you get a hodgepodge of a whole bunch of different subjects thrown into both of them. You can see this PowerPoint deck, 74 pages. There's no way we can make it through 74 pages tonight. So I'm going to try to pick and choose what I think will be most impactful. And then again, next week, Module 10, we go deep into intra-corporate taxes. And that's a heavy lecture too. So before I launch into Module 9, let's do a little Q&A. We got like this, maybe this is why everybody's gone. I kind of call this the dead week, right? Because we got the second exam. The window for the second exam is open. That'll test modules 4 through 8. So tonight I'm lecturing over materials that aren't going to be tested for another month. The advantage to that is that you get a whole week to take your exam. So we got a few in the Zoom room. Hey guys, now's the time for Q&A. If you're having any trouble with the homework or want to ask questions about the exam or anything else, let's do that up front. Everybody's doing okay.
Same layout as last time, right?
Same layout as last time, 40 multiple choice questions, open book, open note. Got an hour and 20 minutes to take the exam anytime between now and midnight next week. The exact date would be the final class.
Yeah, that's what the school is.
Yeah. Normally, not normally, it used to be that we had a final in this class. I scrapped that. So now whatever class period that is, that our final exam would take place the week of finals, that's when it's due. So, and if you get it that week and I don't know, dog ate your homework or something, or you just got drunk the night before and didn't need a little leniency, call me. I've been there. So, but That's a good question. You should be making steady progress on that research report. Check the Canvas site for the example, and you should be kind of knocking those modules off one by one as we look at intercorporate investments tonight. I suspect it'll apply to a lot of the research reports that you're all working on, because most of the companies that you've identified have minority interests in other companies. And depending on how big that stake is, will determine the accounting. So Zoom crew, just interrupt me at any time if you got a question or something. I think I got audio for everybody. Yeah, this is my pet peeve. All these, I got to hit the button 8 times for everything on the slide to come up. All these animations that they build into these slide decks. There's a way to turn them off, but it would take me 5 minutes to figure it out. So I'll just put up with it tonight. Okay, intercorporate equity investments. Tonight, we're going to be talking about the accounting for different investments that we might have in side companies. Take an enterprise like Berkshire Hathaway. Berkshire Hathaway is a conglomerate. They own hundreds and hundreds of other businesses, and they may or may not own them outright. If they own a small stake in another business, say less than 20%, we're going to account for it one way. If they have a quote unquote significant stake in another business, say between 20% and 50%, we're going to account for it a second way. If they own 100% of another business, we're going to account for it a third way. So we're going to need to familiarize ourselves with those 3 different methods of accounting. And that's the first learning objective for module number 9. And there's a lot of different reasons why companies might have stakes in other businesses. Somebody throw one out. Give me a little bit of engagement tonight, so I'm not just the only one talking up here. It's probably on the slide here. Strategic alliances. That's as good as any. Joint ventures, market presentation, vertical integration of your supply chain might be another corporate or competitive advantage, whereby it might make sense to have a level of ownership in another entity. And here's your little flow chart. When we're trying to identify the accounting, the first thing we want to do is identify the level of control. Do we have control? Do we not have control? If we don't have control, there's little to no influence and significant influence. And the general rule of thumb is less than 20% ownership is no influence. But it doesn't have to be that way. If you have less than 20% equity ownership, but you have a contractual agreement or a seat on the board or a vendor relationship that gives you more influence, gives you more power, gives you more say-so over the way that business is run, then you could easily argue for a different kind of accounting treatment. So that would be the equity method under significant influence. And as we look at these different kinds of accounting treatments, I want you to be mindful of what they do to your earnings per share, or your return on invested capital, or your gross profit margin, or whatever it is that your management team has their incentive comp linked to. Because we're introducing another subjective area of accounting, right? We have some influence, we have some say-so over what method of accounting we want to use when we're accounting for intercorporate entities. And that creates an opportunity for shenanigans and gamesmanship and everything that we're supposed to be on the lookout for in this class. And I just said everything on that slide. Okay, slide number 6, slide number 6. This is your cheat sheet. This is half the class tonight, right here on one page. It walks you through all the differences in the accounting treatment as it applies to no influence. We call that the fair value method. And that's pretty simple. We're going to record the value of that investment on our balance sheet at cost. And at the end of the year, say it's a publicly traded stock, like I used the example of Berkshire Hathaway. Anybody know what Berkshire Hathaway's largest shareholding is?
Geico?
Yeah, shout it out if you know.
Geico?
Geico is probably the correct answer. I was thinking publicly traded.
No.
Is Geico publicly traded? I don't know the answer to that. I think it's American Express. So I may be wrong on that, but I know American Express is one of the largest holdings that they have right now. So let's use that one as an example. If we're using the fair market method of accounting, we would book that investment at cost. It would show up on the balance sheet at cost. And then at the end of the year, we're going to record an unrealized gain or loss for the change in the value of that security. So if on January 1, American Express is worth, I don't know, call Warren's holding an American Express worth 20 billion. If it goes up 20% during the year, it's going to go from 20 to 24 billion. At the end of the year, we're going to book a $4 billion unrecognized gain. And that's going to flow through the income statement to net income. So that is, that's the top one there, little or no influence. Significant influence between 20 and 50%. We're going to account for that investment as if we owned it. I want to shift your thinking a little bit. Imagine you owned a partial share in a car wash or an apartment complex. You're not so concerned about the daily fluctuations of that, of the value of that business. What you're really concerned about are the rental rates, the occupancy rates, how many cars are going through the car wash, the types of things that are going to influence your bottom line. So we're going to record that when we use the equity method of accounting, we're going to record the investment on our balance sheet once, and then we're going to subsequently adjust that by the level of income the business actually brings in. It's more of a cash flow or an earnings-based analysis. An earnings-based accounting of the investment when we have a significant influence. And then lastly is the control method. When we just outright control a subsidiary, or maybe even have 100% interest in a subsidiary, we're going to use a consolidated method of accounting. And I'll walk you through an example of this, but it's exactly what it sounds like. We're going to take the balance sheets of Company A and Company B, and we're going to add them together. We're going to take the income statement of Company A and Company B, and we're going to add it together to present a consolidated view of all the financials for the investors. It gets a little bit hairy when you have 90% interest, because then you have a non-controlling stake. But I'll show you how we reconcile all that when we get into that. Piece of terminology on page 7. I want you to be aware of at the top, our authors differentiate between marketable securities and non-marketable securities. Recognize that as public versus private. If we have public or marketable securities, they're going to be very easy to value. You're probably going to be able to go to Yahoo Finance and look up a quote. American Express, Costco, GM, Ford, Boeing, Apple. Easy. Non-marketable securities are private in nature. You're going to have to use some comps, some industry comps. Maybe you're going to have to go back and look at similar businesses that have sold in the last decade and identify 2 or 3 of the same size that might serve as an indication of what a business is worth. A lot more subjectivity in non-marketable securities. You can also use a discounted cash flow analysis to put a value on non-marketable securities. That's another area of accounting where there's so much subjectivity that can come into play. You have an opportunity for management to monkey around with the financials a little bit. So if any of your companies are using, it's called a level 3 analysis. Level 1 and level 2 are publicly quoted securities. Level 1 is usually cash. Level 2 is usually equity securities, fixed income securities, sometimes mutual funds, exchange traded funds. And then level 3 would be non-liquid, non-marketable private securities. If any of you are working on a company that has a lot of level 3 securities listed on their balance sheet, go to the footnotes and find out how they're valuing those, because there's a huge fudge factor in how they could potentially do that. Hopefully they got a good Big 4 accounting firm looking over their shoulder, and you're getting some consistent valuation done by KPMG or Price Waterhouse from year to year to year to year, and that consistency should give you some assurance. But if you have an auditor changeover and you have a big change in value in the same year, well, there may be something about that that you need to do some more digging into. Okay. In this example, our authors are looking at marketable securities. We're using the fair market value of accounting. So let's assume that Alphabet purchases 1,000 shares of Juniper Network for $20 per share in cash. So that's $20,000 of Juniper Networks that who owns this? Alphabet, that Alphabet owns. So we're going to record that at cost. So we're going to debit the investment in Juniper Networks for $20,000, and we're going to credit marketable security or cash in this case for $20,000. Now, fast forward to the end of the year, or maybe mid-year, we're going to sell 400 shares of Juniper common stock for $23 in cash per share. We bought it at 20, we sold it at 23. This is how we record the gain. So we're going to debit cash, we're going to credit a gain on sale, and we're also going to credit, make a credit to the marketable securities account for $8,000. I made myself a note here on the next slide, but now I don't understand what I was trying to tell myself. So I'm just gonna move on and maybe I'll come back to that. Okay, let's look at an example of fair value accounting. So in this instance, we have significant influence. And we're going to account for this using an earnings-based or cash flow methodology that we call fair value adjustments. So let's assume Alphabet's investment in Juniper Networks increases to 25 at the end of the year. And we have an unrealized gain of $3,000. To book that unrealized gain at the end of the year, we haven't sold anything. We're going to debit marketable securities. So the value of what we own is going to increase by $3,000. That's on our balance sheet. We just increased our balance sheet by $3,000. This is called a mark-to-market approach. Anytime you hear mark-to-market, associate that with fair value accounting. And then we're going to book an unrealized gain for $3,000. And you can see that's going to flow through to retained earnings. That's our fair value method of accounting. Okay, and on slide 12 there, you can see how these things typically are reported in the back of the 10K. As with everything else we study in this class, make sure you check those tables in the back of the 10K. You're going to get all kinds of interesting information, and one or two of those items might cause you to do a little bit of more digging. Here's a heads up for your 10-year analysis. One of the things that I've asked you to do in this class is to take most of the accounting treatments, ratios, margin analysis, ROE breakdown, and look at that cross-sectionally across time and relative to peers. So when you look at these numbers back over a decade, you should be able to pull that data out of Morningstar. Oh, by the way, I had a great question last week about Thompson 1. I did find out from Dr. Clark that the university discontinued that subscription. So that's unfortunate. There was a lot of great information out there, and I'm sorry to see that go. So you will have to download this data from either Morningstar, which you still have access to, or Bloomberg. So familiarize yourself with the Bloomberg lab and the resources in there if you haven't already. So as you pull out that 10-year analysis so that you can watch how some of this accounting treatment has trended over time, with regard to equity method of accounting, note that in 2018, FASB changed the rules on us so that after 2018, the mark-to-market adjustments of the value of those investments flow through the income statement. Before 2018, it did not flow through the income statement. So if you're comparing 18 to 19, you may see huge gains in unrecognized gains and losses on the income statement. And that would be the reason why. Okay, let's talk a little bit about debt securities. We just talked about equity securities. Debt securities are similar. There's three types: held to maturity, available for sale, and trading securities. We're going to look at held to maturity first, and they all have their own accounting treatment. So held to maturity debt securities are the easiest. We're going to use a fair market value adjustment on these. For held to maturity securities, we're not going to use a fair market value adjustment. We're going to record any interest payments as interest income. We're going to book these at cost. And because they're held to maturity, we don't ever have to mark to market. And sometimes the value of these securities can fluctuate up and down significantly. We ignore all that because they're held to maturity. Who determines if they're held to maturity? Take a guess.
Whoever's issuing the bond.
Lower bottom. What was that?
Lower bottom.
Whoever bottom. Yeah, I suppose so. So in that instance, it would be the CFO, the CEO, the management team. They hold these securities. They're intercorporate investments, just like they are equities. With that equities, we're using an example of Berkshire Hathaway and American Express. So in this instance, instead of Berkshire Hathaway buying the equity of American Express, they would buy the bonds of American Express. And then Berkshire Hathaway or the CEO or the CFO, they decide for themselves, well, we're going to hold these to maturity, or we're not going to hold these to maturity. The point I'm trying to make is that classification is rather arbitrary. If you're the one that gets to decide whether or not you hold them to maturity, then it's going to be pretty easy to make the income, the unrealized capital gains from those securities flow through the income statement or not flow through the income statement. So you see here, with held to maturity securities, if you buy a bond and the value of that bond goes way up, are you going to get to book those unrealized capital gains? What happens to those unrealized capital gains? They're not, yeah, they're not reported. Nothing. You know, so the temptation for a management team is to say to themselves, man, I wish those weren't held to maturity securities, because we would have just booked a huge gain on those. And if it's rather arbitrary anyway, couldn't you just bounce those down to one of the other two categories, which were available for sale or trading securities? And if you did bounce those down to available for sale or trading securities, then those unrealized gains would flow through to the income statement. And maybe you do find the penny, and maybe you do trigger your bonus payment for that year. Conversely, if those securities had gone down and you had labeled them as trading, the temptation would be to relabel them held to maturity securities, because then you could take those unrealized losses that otherwise would have hit the income statement and you could ignore them. And in investors are happy and you don't have to talk about what a poor investment that was, and you're not taking grief from the shareholder community, and your financials look a little bit better. It's kind of the recurring theme of this class, right? How do you game the system to find the penny with all of these different accounting treatments? You know, first we want to understand the mechanics of the accounting. Then we want to understand the rationale behind the accounting, because most of the time the accountants have good reason for putting these things in place. And then lastly, we want to think a little bit nefariously, I guess, and ask ourselves, if we wanted to, or if somebody else wanted to, how would they take advantage of that system to get themselves paid? Okay, so that was held to maturity securities. Now let's look at available for sale securities. With available for sale, we're going to book the gain or loss, but we're going to hide it. Let me explain to you how this works. I think we've touched on this. I think we touched on this in module 5, but I kind of glossed over because I knew we'd get to module 9 and we'd have the opportunity to talk in more depth about other comprehensive income. And this is the first time we'll touch on it tonight. We'll touch on it several times tonight. When we're dealing with available for sale securities, we're going to take unrealized capital gains and losses, and we're going to record them as other comprehensive income. It's still income. It's just income that is not on the income statement. If you look in your 10K, you'll see an income statement, and then in the back somewhere, in the notes to the financial statements, you're going to see another statement. And the other statement is called other comprehensive income. It's the statement of other comprehensive income. And that's where unrealized gains and losses go on available for sale securities. I call it the basic. So you hear people say the bottom line. Well, the bottom line is not really the bottom line, because there's a whole bunch of stuff that accountants and FASB got together and said, these are so unusual in nature, but these are so infrequent in nature, or they're so volatile that we want to remove them from the face of the income statement for the sake of keeping the data usable. Because if we were to put these numbers on the face of the income statement, it would cause so much volatility from quarter to quarter, from year to year, it would make these statements less useful. So what you see is a typical income statement. You get revenues, less cost of goods sold, less selling, general and administrative expense, you got inventory, so on and so forth. Operating income, less interest, less taxes, then you got net income. And then below net income, you have other comprehensive income. Way down here below the bottom line in the basement, we're going to put things like unrealized gains and losses on available for sale securities. I'm pretty sure the last time it came up in this class, we were talking about unrealized gains and losses on the translation of statements into US dollars. So say, for example, you have a subsidiary that's reported in euros. Annually, you have to reclassify that to dollars. That can be a very volatile number, so we put it in other comprehensive income. Then we have an accumulated other comprehensive income account that posts to the balance sheet. So income, other comprehensive income flows into accumulated other comprehensive income, which is reported on the statement of account. Questions about that before we move on? I know that can be a little complicated, especially in the nomenclature. I had another thought, I lost it. It'll come back to me. So slide number 19 gives you a little sneak peek into what you might see at the back of Alphabet's 10K filing. You're going to get a breakdown of all the securities, how they're classified, what their current value is, adjusted cost, fair value, so on and so forth. Oh, I remember what I was gonna say. That section of the balance sheet and that statement of other comprehensive income is a great place for you all to go looking for value, hidden value. And here a few years ago, I'm trying to think of a specific example, but another one of these areas of accounting where we will use the other comprehensive income is in changes to pension things. So think about pensions. I think we talked about this already, but think about a defined benefit pension. You all probably know somebody, an aunt, uncle, grandma, and grandpa that retired with a defined benefit account for real pension, got a check in the mail for the rest of their lives. My granddad worked for Phillips 66. He's since passed away a long time ago, but when he retired in 1985, he started getting a check in the mail from Phillips 66. And he lived from 1985 to 2002. And my grandmother is still alive. From 2002 to 2021, Phillips 66 wrote him and now her a check every month from 1985 to going on almost 40 years. So 36 years, every month, that household has got a check from Phillips 66. So how do you account for that? That's a future liability. Well, you have to take, your actuaries have to get together and make some estimates on who they employ and how long they're likely to live and whether or not they're married and whether or not there's any medical benefits associated with that. Take this big hairy mess of a calculation and discount it back to time zero and put on their balance sheet a liability payable to Don Cushenberry, my grandfather, in the amount of what probably amounted to, that's probably close to $1 million worth of cash flows over that time period. So you have that on your books. Then you have an investment account set aside to fund that. Well, you multiply that across an employee base as big as Phillips 66, and now you have $1 billion liability, tens of billions of dollars. This was one of my first jobs after I got my MBA years and years ago, and a good place for you all to go looking for jobs too. There's a company here in town called DeMarsh and Associates. I think they're the 6th or 7th largest financial firm in the case of the metro area, and they do defined benefit pension plan consulting. I used to work for them, and we worked with companies like IBM, Coca-Cola, Pricewaterhouse, Maytag, a lot of universities, and we would help them invest their investment plans. And all in, we consulted on about $70 billion worth of plan assets. Good size business. Well, you go through a market period like 2008, COVID, maybe even the reverse of that, 2013, big run up in the market. You got a $20 billion pension investment account, and you lose 50% on it, which a lot of companies did in 2008, that's a $10 billion loss. You can't put a $10 billion loss on your income statement and still have the income statement make sense. Because your annual income might be, 10, 20, 50, maybe $100 million. That could be a great year, $100 million in income. Well, here comes the $10 billion loss that you're going to put on top of it. And FASB says, no way, we're not going to do that. We're going to make sure those gains and losses on pension investment accounts are recorded in other comprehensive income. So the analyst community can make sense of how well the business is performing, which is one of the functions of the income statement. We need to understand how well the business is performing. We need to understand the operating nature. That's why we analyze operating income. That's why we look at net operating profit margin after tax. We spent a lot of time in NOPAT in module 3. That's also very useful information to us. And we can segment that against all the other things that we're going to put down in other comprehensive income. So together, those two statements make a lot of sense. Together, they give us the full picture. Separately, they allow us to focus on the operating nature of the business versus all this other stuff that businesses are into, but might not be core to their businesses. And we need to have a good understanding of it, but we also need to understand that it's as liable to move one way as the next way, given the volatility of things like foreign currency translations. So we were talking about other comprehensive income for available for sale securities. When we have a bond that's classified as available for sale, we're gonna take those unrealized gains and losses and we're gonna put them down in other comprehensive income. When we actually sell that bond, those gains are not unrealized anymore. Now, we've just realized those gains and losses. And upon that transaction, we're gonna take those gains and losses out of other comprehensive income and move them up and actually put them on the balance sheet. Now, they've materialized, they're real, and we have the cash in our bank account, so we want that on the income statement. Okay, analyze and interpret the equity method investments. Okay. So most of that equity and fixed income, what we've talked about so far, was focused on the fair value method. In one way or another, we were marking those investments. We were taking some measurement of what the investment was worth January 1, comparing that to what it was worth on December 31st, and taking the difference and pushing it into either income or other comprehensive income. That's all fair market value accounting. Now we're going to shift gears a little bit, look at the equity method of accounting. This is associated with significant influence. Think to yourself 20%. That's a rule of thumb. Could be less than, could be more than, depending on the nuances of your business. But 20% is a good number to keep in your mind. Okay, when I say could be more than, could be less than, the last 3 bullet points on slide number 24 here are worth, circle those. That would make for a good testable question, a good multiple choice question. You know, company A owns 10% of company B, but they have one of these 3 bullet points. They're entitled to a seat on the board of directors. The investor controls technical know-how or patents. The investor has legal contracts with the investee. Any one of those 3 bullet points could cause them to, quote unquote, have a significant influence over their investee. So just be mindful of that. Okay. How do we account for the equity method? This was on the cheat sheet that we looked at a few minutes ago. I asked you to star and come back to on a open book exam. That would be one to have at the ready. We're going to record any investments that fall underneath the significant influence category at purchase cost. And then we're going to increase the value of that investment based on the income generated by the company we just bought. We're going to decrease the value of that investment based on any dividends that they issue to us. And those two transactions will naturally adjust the carrying value of that interest in a manner that's consistent with the percentage we own. So let's look at an example here. We'll walk through this. This is a good illustration. Let's assume Google acquires a 30% interest in Middle. I don't know Middle, but Middle. Middle reports profits of 100 and pays a $20 cash dividend. So you can see here, the initial transaction, pretty straightforward. We got $300 in cash walking out the door, and we have an investment in Middle that we're going to debit. That's a non-cash asset. No problem. So now let's go to transaction number 2. At the end of the year, Middle reports $100 in income. We're going to increase the value of Middle on our books by our proportionate share of income. What's our proportionate share of income? Yeah, 30%. So 30, you can see right there in the transaction. Our investment in middle just went up by $30, which corresponds to our 30% interest in the company. Now, transaction number 3, middle pays a $20 dividend. 30% times 20 is $6. So we're going to decrease our investment in middle by $6. And then you add all those transactions up, and at the end of the year, the carrying value of our investment in middle was $324. A little bit counterintuitive. You think company pays a dividend, well, that's a good thing. And I suppose it is a good thing, but we're not going to account for it as if it increases the value of our investment. We're only going to increase the value of our investment in the equity method based on income that the company generates. It's an income-based approach to valuing that investment on our books. Okay, I'm sure that's as clear as mud right about now. So let's move on, see if we can add some clarity to it. Slide number 27 is a nice graphic. Spend some time with that. Okay. What happens if the purchase price of the investment is greater than the book value? The example we just looked at, Google paid $300 for a 30% stake. The business was worth $1,000. It's all nice and neat math. Let's look at an example where the math's not quite so nice and neat. So in this instance, Google pays $400 for a 30% stake in middle. The $300 equity investment is 30% of the book value of middle. So we know what their book value is. We can see their balance sheet. 30% of that would be 300. We bought a 30% stake, but we paid more than 300. So what do we do with the extra 100? Typically, that would be categorized. Anybody have a guess? Typically, that would be goodwill. You see it all the time. Mergers and acquisitions very rarely close for book value. They almost always close for higher than, sometimes lower than, but for the sake of argument, let's just say higher than. And the difference usually shows up as goodwill. But it can show up as intangible assets or unidentified depreciable assets, which are the bullet points on the bottom of slide number 28 here. Star those, circle those. That would be another good testable exam question. So company A pays 120% of the book value of company B. What do they book the 20% as? Your choices are goodwill, unrecognized depreciable assets, or identifiable intangible assets, such as patents. What would somebody give me an example of an unrecognized depreciable asset? Yeah, so it would be an unrecognized asset. So it's an asset that's not on the company books.
Brand deal.
Good call. Brand deal, could be like consumer base, legal contracts. We own some JB Hunt. It's a trucking company, and they have an exclusive deal to distribute throughout the Midwest with Union Pacific. And those legal contracts are worth a lot, and they've had them a long time, and it significantly adds to the value of JB Hunt. That might be an example of an unrecognized depreciable asset. I don't know if depreciable might be a question mark beside that one. You know, another example might be land or real estate that's already been fully depreciated. You know, a lot of times you'll use an accelerated depreciation schedule to fully depreciate an asset before all of its value is really gone. So somebody might be willing to pay more than book value because those assets still have real value, but they've been fully depreciated. In which case, you would just write them up and then depreciate them down over time. Okay, let's move on. Okay. What equity method accounting issues? Okay, the 2 points I wanted to make on this slide. The first bullet there can be a substantial difference between the book value of an equity method investment and its fair value. That's what we just talked about. Right underneath there, it says, an increase in value is not recognized until the investment is sold. So for example, you could buy an investment. I don't know, some tech high flyer. Give me an example of a tech high flyer. Apple, okay. Let's call it Apple 40 years ago. Apple 40 years ago, you buy into it. You're using the equity method of accounting. How does your investment in Apple increase? It's all unrecognized. It all is unrecognized gain, but it's based on their income. So every time Apple earns a little bit, just like the example we looked at on the last slide, we take the percentage income. If we own 30% of the business, we take 30% of the income and we add it to the value of Apple on our balance sheet. Well, if you do that for 10 or 20 years, you probably have a nice little gain on your Apple holding. It's appreciated quite a bit on your balance sheet. Relative to the amount that it's appreciated in the stock market, you probably have a fraction of what it's really worth. That's one of the objections to the equity method of accounting, is that it doesn't always capture the full upside and downside of an investment, especially when you stretch it out over years. Now, if it's on the upside, meaning if you're missing out on some euphoric skyrocket of a stock like Apple, the accountants don't really take issue with it, but they do take issue with impairment. If you have an investment on your books and it becomes impaired, they're going to require you to write that down. How do you test for impairment? It's usually the job of the accountant. It's usually the job of your auditor at KPMG or PwC. They're going to come in, they're going to look at your books, they're going to test the cash flow generating abilities of your investment in Apple or real estate or car wash or whatever you got. And if it doesn't have the same ability to generate those cash flows as it did when you initially bought it, the auditors are going to say, we really think you need to write the value of this investment down on your books. And you'll see that. I think the author's given us an example here in a minute. I know it's in here somewhere. But I would also encourage you to look in the footnotes of your 10K for any impairments that your company has taken. Because even the example that the authors give in the book, which I think was Heinz or Kraft, I was refreshing my memory on this lecture this afternoon, and I was looking at the slide, and I was reading it. I'm reading it, and I have read a lot of these, and I'm just shaking my head thinking, the language is so ridiculous that the management team is using when what they're really trying to say is, we effed up. They're attributing it to different sales channels and geographic events and foreign currency and half a dozen other factors. When the bottom line is, we just messed up. We bought a bad investment. And you rarely see management teams take accountability for something like that. But 90% of the time, when you book an impairment, you as the analyst need to recognize that that represents a bad decision somebody made. Hold them accountable. You made a bad decision. If they have one impairment after another impairment after another impairment for several years in a row, you need to seriously question the quality of your management team. Now, that could go back 5 or 10 years if it's been on their books a while. It could have been a former management team that did that. Which is a whole nother bag of tricks. So as soon as you get in your CEO job, this is CEO inside tips and tricks. One of the first things I want you to do when you get your first CEO job is go through the financial statements, whatever company you're working for, and identify any opportunity to take an impairment or any opportunity to declare something a discontinued operation. Now, what's going to happen? You declare something impaired, or you declare something to be a discontinued operation. That's your opportunity to write it down. Write it down means take a big loss. You're mark to marking, that's called mark to market, the investment, so that it reflects its current fair value. And you're going to take a huge loss, and your numbers are going to look like crap. And you're going to get to blame it all on the prior management. Well, if you're a savvy CEO, you're probably working with some consultant that helped you negotiate your pay package. And in your pay package, you probably got a package of options. And most of the time, CEOs have their options linked to a strike price. And that strike price is usually set over a period of time after the CEO takes the job. So if you take the job on October 25th, then the strike price of your options is going to be the average daily trading price of the stock between October 25th and December 31st. So what's a little maneuver like this do? When you declare something to be impaired and you take a big loss? It drops the price. So what you want to do when you get that CEO job is pull every accounting trick that you can to make your numbers look as bad as they can, or you can blame the former management team, drive this price of the stock down so you get the lowest possible price for your vesting, and then turn the company around and don't be afraid to twist your arm, patting yourselves on the back as you post better numbers the next quarter and the next quarter and the next quarter. Stock price takes off. You have super cheap vesting. Yeah, you exercise all those options deep in the money, cash out with millions of dollars, and you may or may not have added any real value to the business, but you learned how to manipulate the accounting in FIN 5561. Thank you to Vern Cushenberry. I'll take my commission in cold beer. And yes, all good things. So I say that a little tongue in cheek, but I swear I've seen it. I swear I have seen execs do almost exactly that. Slide number 30 gives you an example of an investment that AB InBev made. This was before they were one company. And I don't have anything to say on that slide. Okay. The next few slides would also make great test questions. So you might just star these so that they're at your fingertips if you see this on the exam, because this stuff's a little confusing. So one of the ways that this might show up on an exam is Company A has an investment in Company B. Company A uses the equity method of accounting to account for Company B. How does that affect their return on equity? Well, what we need to understand is that if we're using the equity method vis-a-vis the consolidation method, we're only reporting the income. We're not reporting the sales or the expenses that it took to generate that income. So that can distort your net operating profit margin a little bit. It can overstate it. Same way with asset turnover. because we're not reporting all of the assets, that can have an effect on the asset turnover. Now, that one can be a little bit indeterminate because it affects both the numerator and the denominator. Our authors give us an example of financial leverage. When we don't consolidate the liabilities, when we exclude those, the liabilities of the, I'll call it the subsidiary or the investee company, that can understate the financial leverage. Now, on the whole, because we do focus on income, return on equity will remain unaffected. No effect on return on equity. The components of return on equity can be affected as we use the equity method versus the consolidation method. But on the whole, the return on equity number is the same. The conclusion from that is that the quality of earnings can be greater. If we use the equity method, we're more prone to assess the quality of earnings as being a little bit higher than it otherwise might be, assuming the company's profitable. Okay, let's talk about the consolidation method. We talked about the fair value method. We talked about the equity method. Let's talk about the consolidation method. Now we're dealing with businesses that are greater than 50%. We're going to add the balance sheet together. We're going to add the income statement together, and we're going to produce consolidated financial statements. And I'm going to show you what those look like. Okay, here we go. This is the best way to comprehend what we're doing when we pull together a consolidated financial statement here on slide 40. So we have two companies, Penman and Nissen. Penman owns Nissen. They own 100% of Nissen. So to consolidate those financials, we're going to take the books of the parent co, Penman, and we're going to take the books of the subsidiary, Nissen. We're going to line them up just like we have in this slide. Now we're looking at the balance sheet here. So we're going to add current assets to current assets. We're going to add investments to investments, property, plant, equipment to property, plant, equipment. And we're going to produce the consolidated statement of cash flows with a column for consolidating adjustments. And you can see there, I'm hopeful that these are somewhat self-explanatory. We have a consolidating adjustment for the first one there in column 3, $3,400 for the investment in Nissen. Now the consolidated, the Penman has an investment in Nissen, but when we produce consolidated financials, the parent co does not have an investment in Nissen. They own Nissen. They have a 100% ownership interest in Nissen. So we don't consolidate that. We make an adjusting entry for that. And then as you pan down, you'll see the next two consolidated entries basically account for the book value of the subsidiary. We have contributed capital and retained earnings. The contributed capital of Nissen is $2,000. The retained earnings of Nissen is $1,400. $2,000 plus $1,400 is $3,400. The exact value of the investment in Nissen up above that we canceled out when we consolidated those. So you can see that those three numbers, they add together to basically constitute the equity value or the book value of Nissen. And then lastly, down at the bottom, the income statement, we have the equity income from investments, a $400 equity income from investments that Penman would have based on its investment in Nissen. We're going to remove that so that we can consolidate the net income of both companies. And you have your consolidated financials on the far right there. Okay, now, basically the same thing. We're going to look at it again, only this time, Penman does not own 100% of Nissen. Penman only owns 80% of Nissen. So the first three consolidated entries are the same. Basically, we have the book value of Nissen times 80%. This time we have to add a line item for non-controlling interest. This would be the 20% outstanding of NISM that Penman does not own. Notice that that non-controlling interest flows through to the consolidated financials. And then below, basically the same entry, only this time we're making an adjustment for 80% of NISM's net income, which amounted to $320. And we're putting a line item on the consolidated financials that says net income attributable to non-controlling interest. I'm sure most of you have seen that. You may or may not have had a full understanding of how that actually ended up on the financials. That's how it ends up on the financials. Okay. This was the slide I was talking about earlier, slide number 46, that talks about crafts, goodwill impairment. I'll let you read that on your own time. I'm kind of booking it here because we're an hour in and I want to make sure I touch on everything that's technical in nature for sure. Okay, slide number 48. This, yeah, I had mentioned that module 9 is kind of a hodgepodge of different items. Now we're moving beyond the accounting for intercorporate entities. Then we're moving into just other stuff. And one of the other items that our authors include in module 9 is the accounting for foreign subsidiaries. And this goes into other comprehensive income, like I had mentioned. At the end of the year, we have to translate the balance sheets of any subsidiaries that we have operating overseas. And if they're denominated in euro or yen or some other foreign currency, the value of those assets can fluctuate significantly. And we most certainly will have a foreign currency translation adjustment, gain or loss. That gain or loss every year flows through to the statement of other comprehensive income. And then on the balance sheet, you'll see that in accumulated other comprehensive income. So slide number 49 gives us a little bit of detail on how that works. To gain a better understanding of it, our authors oversimplify this and they say, assume a European subsidiary has no changes in its balance sheet during the year. That's an oversimplification, right? That's not gonna happen. If you have any kind of operating business, you're gonna have changes in your balance sheet, but assume they don't. And the US dollar strengthens vis-a-vis the euro, $1.25 dropping to $1.10. Well, that's going to produce a currency translation adjustment of, I think they call it $225 million here. And that would be posted to other comprehensive income. Now back to Alphabet, and our authors give us an example of what that's going to look like when you find it in the back of your 10K filing. When you go look at the fine print, you're going to see something that looks like this, and it's going to give you a little bit of detail on other comprehensive income, where it came from, what the amount is. If you got big numbers back there, know what they are, know what's driving them. And you know, I'll say this again because we have a rule around the office that if you want somebody to remember something, you need to say it 7 times. So it's the rule of 7. And I probably haven't said this 7 times, but it's about materiality. If you go look at other comprehensive income in the back of your 10K filing, and you have a couple $1 million worth of other comprehensive income, and your balance sheet's tens, 20s, 30 billion dollars plus in total assets, well, then your other comprehensive income is not material. And you can end your analysis of it. I'm trying to teach everybody in this class how to be a good analyst. And one of the ways that you become a good analyst is by differentiating what's meaningful from what's not meaningful. And that's all about materiality. So don't trip yourself up. And don't go deep into a rabbit hole you don't have to go deep into. I mean, that's part of the skill set that we're trying to pick up here in this class. Now, I want you to understand how the accounting works, and that's why it's testable material. And the test will determine your comprehension of that information. So when you get to the research report, that's the applied skill set. If you're looking at this and you come to the determination that it's not material, move on. Move on to what is material. Some of you will have to go deep into this material. Others of you will be able to completely ignore it and might have to go deep into lease accounting or inventory accounting or taxes or something else. Okay, derivatives disclosures. This is another area of other comprehensive income, and it breaks down like it breaks down between two categories. What is a derivative? Derivative is a security that bases its value off of another security. An options contract, a futures contract, a forward contract, these things are all dividends. Well, it's very common in business for companies to enter the derivatives market for the purposes of hedging. Sometimes there's a specific asset a company needs to hedge. Our authors give us some good examples at the bottom of slide number 57 here. Tiffany & Co. might need to manage the price volatility of precious metals. So in order for Tiffany to run its business, they need to know what the price of silver and gold and diamonds are going to be for the next couple of years out so that they can manage their supply chain. Well, there's one really good way to gain some certainty around their business operations, which is to contract today for what the prices of those materials are going to be 18 to 36 months from now. And you do that using the derivatives market, and that's called hedging. Harley-Davidson, Southwest Airlines is another great example. They want to hedge the cost of their jet fuel, so they know how much it's going to cost to shuttle passengers all over the world. Well, there's two types of hedges. There's an asset hedge, which Cisco Systems, this second one from the bottom, that would be an asset hedge. Cisco Systems manages exposure to changes in equity investment values. So they might own other stocks or bonds. And if they are concerned about the fluctuating values of those, then they can enter the options market so that if that stock drops significantly, they have a put and they won't incur any of those losses. Earlier tonight, we used the example of Berkshire Hathaway and American Express. If that holding on Berkshire's balance sheet got so big that management started to get a little concerned about losses, they could enter into a derivatives contract, buy some options on that. So if the value of that stock did go way down, the value of the options would go way up, and it would be a push. If it were properly hedged, the net gain or loss would be zero. That's called an asset hedge. Contrast that to cash flow hedges. Well, I said asset hedge. Number one is hedging the fair value. So you can call it a fair value hedge. The second type of hedge is future cash flows. That would be the Southwest Airlines. They're hedging future cash flows associated with buying jet fuel today, tomorrow, 6 months from now, 6 years from now. Here's what you need to know about the accounting. Hedging the fair value of a fair value hedge obviously uses fair value accounting, meaning that the net change in the value of the derivative instrument used to hedge the asset is recorded as an unrealized gain or loss on the income statement in the period it was incurred. We already looked at fair value accounting, that's pretty easy. Cash flow hedges, future cash flow hedges are the ones that are recorded in other comprehensive income. And if you know just that much, you're probably good on the accounting for derivatives. Okay, let's talk equity carve-outs. What's an equity carve-out? Any guesses? There we go. The answer's on slide 65 here. An equity carve-out is a sell. So we spent the first part of tonight's class talking about how to account for investments in a subsidiary or another equity. An equity carve-out is when we get rid of that investment. And there's several ways to do it. We can get rid of it just by selling it. The accounting for selling an investment is a piece of cake. You just credit the investment and debit cash and you're done. We can IPO it. That's the accounting for an IPO is almost identical to a sale. You're instead of just selling it for cash, you're first creating a publicly traded security out of it. But you do that in concert with a major brokerage house, and the transaction is the same. At the end of the day, you don't have the investment anymore. You do have cash. You just went through the public markets and a brokerage house to get there. Then you have spin-offs. If you want to make some money in the market, look for spin-offs. Spin-offs are this peculiar little segment of the market that lead to forced selling pressure. Most of the market is dominated by big pools of money. So take a mutual fund. I used to work with Buffalo Funds. I know this dynamic very well. If you're a mutual fund manager and you run a large cap fund, trying to think of a good example. Kraft. I'll use the example of Kraft. Several years ago, Kraft sold off another little unit called Mondelez. So one day you log into your terminal and you're looking at all your holdings and you see Kraft. The next day you log into your terminal and you see all your holdings and you see Kraft. And then you see Kraft and Mondelez because they spun off this investment in Mondelez. And when you spin off something, you just create another stock and you issue it to all the current stockholders of the company. So now the portfolio manager is looking through all their holdings and they're thinking to themselves, well, I don't want to own Mondelez, I want to own Kraft. Mondelez is this little stepchild of an investment that I never had any interest in anyway. Plus, it's a small cap company, and I'm a large cap mutual fund. My charter won't even permit me to own Mondelez. So what do? We sell it, get rid of it. You're like, okay, well, that one doesn't fit anymore. That's a misfit, so we sell it. Well, take that single behavior and compound it across thousands of investors making the same decision. And 3 to 6 months after a spinoff occurs, you typically see this forced selling pressure that drives the price of the stock down 20 to 30%. But the beauty of it is that 20 to 30% decline in the price of the stock has nothing to do with the underlying economics of the business. It's just forced selling pressure. So what typically happens is you can step in and pick up that stock on the cheap. And if you buy a basket of spin-offs 3 months after they were spun off, and you had done that consistently for the last 20 years, what you would have experienced is a return that beats the S&P 500 by about 19% per year. So pay attention when you see that word spin-off. Split off. The difference between a spin-off and a split off is the voluntary or involuntary nature of it. With a spin-off, it's involuntary. One day you got Kraft, the next day you got Kraft plus Mondelez. With a split off, they ask you if you want Mondelez or not. And you get to elect, yes, I want to participate in that, or no, I don't want to participate in that. but the accounting form is basically identical. And you can see the accounting's pretty simple here, just 67, you might just star 67, that's your cheat sheet for the accounting for those. And we are just about at time, but before we call it, let me make sure I got everything here. Yep, that's it. Perfect timing. Okay, Zoom crew, that's all I had for tonight. I got the test posted online. Any last minute questions before we call it quits for tonight? All right, gang. Thanks for your time. I'll see you in a couple weeks.